I'm here today at the NYSE's ETF Summit, and joining me is Darek. He is the head of funds and managed accounts group at Northern Trust Asset Management, including Flex Shares. Darek, it's wonderful to have you here. Thanks for joining me today.
Good to be here, Judy. Thank you.
So now, Darek, tell me, how should advisors be preparing their portfolios in 2023?
It is a very interesting period. Certainly, advisors are worried about higher interest rates, high inflation, increased volatility in various aspects of geopolitical instability. So with that, the main thing that we tell advisors is be prepared for unprepared. Be prepared for unexpected. That said, there are some trends that we observe that among advisors. So one is many of them are interested in real assets. And we think about real assets in context of natural resources, infrastructure, to some degree real estate. Many of them are interested in those because of the inflation hedging qualities. Some of them appreciate additional income generation and uncorrelated components. Beyond that, many are now really looking into very much improved balance sheets. So quality companies are much more appreciated than they used to be, particularly quality companies that pay dividends. I think that most forecasters agree that equities have a diminished return expectations for the next 5 years comparing to the past decade. So the components that may be generated through dividends, another 2, 2.5%, 3%, it matters. And beyond that, I think that we still see a lot of interest in lower volatility. We might come back to that. And certainly also credit now, particularly high yield credit, with interest rates being higher.
All right, so Darek, tell me, what's your favorite NYSE ETF in your lineup?
Okay, so I always have to say first that we encourage all investors to look at flexshares.com and evaluate the entire spectrum of our products, including those that are listed on New York Stock Exchange. But if I were to pick one, I would focus on quality, low dividends products lineup, and specifically the ticker for the US version listed on New York Stock Exchange is QLV. And what we find is that this component of perhaps quality companies that are combining their characteristics with lower volatility are of interest to many advisors and their investors. And even though one would say that they perform in an expected environment where they give up a little bit of a return for protection on the downside, in a highly volatile market with lower return expectations, there are some components of that return spectrum that offer some protection by giving up some upside that are very attractive to many, many advisors. I think that the fact that they also provide different correlation characteristics matters, and QLV in particular is constructed in a way that reduces any sector imbalances or country imbalances for the international version. So QLV it is.
Okay, all right, well, wonderful to talk with you. Thanks for joining me.
Thank you very much, Judy.